Imagine running a massive nationwide business where you actually lose customers over the course of a quarter.
Right. Not ideal.
Yeah, exactly. You process like 1.5% less of your actual physical product, and at the exact same time, you face a 27% crash in the market value of the commodities you sell.
Which is brutal.
Right. Plus, your trucks are battling historic blizzards. Fuel prices are incredibly volatile. I mean, under those conditions, you would fully expect the executives to get on the earnings call and just, beg for mercy.
Oh, absolutely.
You'd expect them to slash their guidance, but instead, this company ended the quarter expanding their profit margins and generating nearly $1 billion in pure, unrestricted cash.
I mean, in literally any normal industry, that combination of headwinds is an absolute death sentence for a quarterly earnings report.
Yeah, Wall Street would normally punish the stock instantly.
Right, they'd crush it. But, when you hold a physical monopoly, the normal rules of corporate gravity just don't seem to apply.
And that is the exact paradox we're looking at today. Welcome to Talk Tickers, the deep dive where we tear apart corporate earnings calls to find out what is actually happening beneath the financial makeup.
Because there's always a story beneath the numbers.
Exactly. We skip the Wall Street jargon, we look at the raw data, and we try to figure out if a stock actually belongs in your portfolio. And today, our mission is waste management. Ticker symbol is WAM.
We're looking at their Q1 2026 earnings call, which featured CEO Jim Fish and COO John Morris.
Right. And look, it is arguably the least glamorous business on the planet. I mean, it's literal garbage.
It is. But if you are a retail investor, you have to separate the aesthetics of a business from its underlying unit economics, right?
Totally.
The mechanics of how waste management generated this kind of cash amidst all those headwinds it's a masterclass in corporate pricing power and, surprisingly, technological leverage.
Yeah, the tech stuff is wild, and we'll get to that. But I want to start right at the top of the income statement because the headline numbers in this initial press release are just wild.
They really are.
Operating EBITDA grew by nearly 6% year over year. And for anyone managing their own portfolio who might be new to that term, EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Basically, it's the raw operating profitability of the business before the accountants step in and do their thing.
Exactly. And a 6% growth rate in a mature physical world company like this is significant. But, it's the margin expansion that really caught my eye.
Oh, the margins were incredible.
Right. Their core collection and disposal business hit 6.4% EBITDA growth, and their margins expanded by 110 basis points.
That is 1.1%. For those who don't speak in basis points.
Thank you. Yeah.
And you are right to focus on that because margin expansion in an industrial business of this scale is incredibly difficult to achieve.
Right, because we aren't talking about a software company where distributing another copy of an app costs like $0.
No, not at all.
We are talking about a company operating 19,000 heavy diesel trucks, paying thousands of unionized drivers, and managing literal mountains of physical waste across the continent.
Yeah, it's highly capital intensive.
So to squeeze out an extra 1.1% in profit margin across billions of dollars in revenue, that means they've fundamentally altered their cost structure.
They did. And that operational efficiency flows directly into the cash flow statement, which, as you know, is the lifeblood of any defensive stock.
Definitely.
Their free cash flow for the first quarter was a staggering $920 million.
Just insane.
Right. And operating cash flow hit $1.5 billion, which is an increase of $300 million compared to the exact same quarter last year.
Wow. And I want to make sure we differentiate those two things for the listener. Operating cash flow is the cash generated by their normal business operations, right? Like picking up trash and running landfills.
Well, exactly.
But free cash flow is what is left over after they pay for all their capital expenditures, like buying new trucks or building new facilities.
Right. It's the money they can actually use to reward shareholders.
So to have nearly $1 billion in free cash flow in a single quarter means they have an immense amount of discretionary cash to play with. But all of this cash generation brings us to the core contradiction of this quarter. We really need to talk about pricing versus volume.
Yeah, this is where the underlying strength of their business model is entirely exposed. It's fascinating.
It is. So their quote-unquote core price increased by 6.3%, and their yield increased by 3.9%.
Important distinction there.
Yeah, and specifically their municipal solid waste yield, which is, the everyday garbage you and I put out on the curb that was up a massive 6.9%.
Right.
But as I mentioned in the beginning, their overall volume was actually down 1.5%. So they are picking up less trash, but making significantly more money.
Which is the dream, really.
It is. I look at that and think of like a streaming service. If a streaming platform loses 1.5% of its subscribers, the stock usually tanks.
Instantly. Wall Street hates subscriber loss.
Exactly. But if they raise the subscription price by 6% on everyone who stays, they end up with record profits anyway.
The math is very similar, yeah. But the mechanics of core price versus yield in the waste industry, they require some parsing. They are definitely not interchangeable terms.
Then let's break that down, because when I read core price up 6.3% and yield up 3.9%, my initial reaction is just, okay, they're charging people more.
Right. Yeah, it sounds like the same thing.
Yeah, but there has to be a structural difference between those two metrics for management to highlight both of them on the call.
There is a massive structural difference. So core price is simply the sticker price.
Okay.
It's the rate increase they send out on the notice to the customer. If Waste Management decides they're raising their baseline rates by 6.3% across the board, that is the core price. It is basically the ambition of the company.
It's the asking price.
Exactly. But yield is the reality check.
Ah, okay.
Yield is the actual net amount of money realized on the invoice after all the frictions of the physical world occur.
What kind of frictions?
Well, yield has to factor in the discounts that local salespeople negotiate to keep a large customer, for example.
Oh, sure.
It factors in churn. The customers who get that 6.3% rate hike notice refuse to pay it and just cancel their service. And it also factors in the mix of services provided. So yield is the actual realized cash increase per unit of waste.
Okay, so if the asking price was 6.3%, but they only actually realized a 3.9% yield across the whole business, it means they met some resistance out there.
Right. They lost some price-sensitive customers, or they had to offer some discounts.
Makes sense. But what really stood out to me was the municipal solid waste number. The yield there was 6.9%.
Yeah, that's a huge number for municipal contracts.
Right. That means after all the complaining from city councils, all the municipal budget debates over trash collection, cities are still paying nearly 7% more for the exact same service.
Yeah, they are.
My question is, why don't these cities just leave? I mean, if a vendor hikes my rates by 7%, I'm shopping around.
Because in most cases, they literally can't shop around. And this brings us to a concept Jim Fish discussed at length on the call, which is airspace preservation.
Airspace preservation, I mean, that sounds like an aviation term, not a garbage term.
I know, it does.
Yeah.
But in the waste industry, airspace is the most valuable commodity in existence. It refers to the physical, empty volume remaining inside a permitted landfill.
Okay.
You have to understand that permitting a brand new landfill in the United States today is nearly impossible.
Because of the regulations.
Regulations, yeah. It is incredibly expensive. It takes decades of environmental studies, and it faces extreme political pushback. I mean, nobody wants a new landfill in their backyard.
NIMBY, right, not in my backyard. So the landfills that already exist are essentially finite monopolies?
Precisely. And Waste Management has longer remaining landfill lives than almost anyone else in the entire industry. They control the holes in the ground.
Wow.
Because that empty airspace is so finite and so valuable, Waste Management can demand premium pricing. If a city or a commercial customer looks at a 7% rate hike and threatens to leave, Waste Management is, frankly, entirely comfortable letting them walk away.
Wait, really? They just let a massive municipal contract walk?
Absolutely, because preserving that empty space in the landfill for a future customer who is willing to pay the premium is actually a much better long-term financial strategy than filling it up today with cheap trash.
Wow, that completely flips my perspective on the 1.5% volume drop. I was looking at a drop in volume as a failure to retain customers.
Right, which is the normal way to look at it.
But you're saying it's actually an intentional curation of their customer base. They're actively shedding low-margin trash to preserve space for high-margin trash.
Exactly. They are monetizing empty space by strictly enforcing their pricing power. And, I mean, it generates so much cash that they returned $730 million to shareholders in Q1 alone.
In one quarter.
Yes. That was $385 million in dividends and $344 million in share buybacks, which they just resumed, by the way.
And the thing is, they aren't doing this by taking on reckless debt either. I noticed their leverage ratio is sitting at 2.94x.
Which is incredibly healthy.
Yeah, for the listener trying to evaluate balance sheet health, the leverage ratio, specifically debt to EBITDA, measures how many years it would take the company to pay off its entire debt using its current operating profits.
Right.
And in the heavy industrial space, anything under 3.0x is generally considered the gold standard of a bulletproof balance sheet. So they are funding these buybacks purely out of their operational cash flow, not by swiping the corporate credit card.
It's an incredibly conservative capital structure, which is exactly what gives them the flexibility to be aggressive with their pricing.
So the headline is that they are earning more money on less garbage through sheer pricing power. That is a great macro narrative, but I want to get granular here.
Let's do it.
Because a 1.5% drop in volume isn't entirely just them walking away from cheap contracts, right? Management spent a lot of time on this call explaining away that volume miss, and frankly, some of it sounded like the oldest excuses in the CEO playbook.
Oh, I know where you're going with this.
Yeah, I want to look at the story behind these numbers, starting with the weather. Whenever an executive blames the weather for missed earnings, my internal alarm bells go off.
Sure.
It just sounds like a convenient cover for a weakening underlying business.
Your skepticism is entirely warranted. I mean, the weather was bad is the ultimate unfalsifiable excuse for a poor quarter.
Exactly.
But in the case of a route-based logistics business like waste management, severe weather isn't just an inconvenience that slows down foot traffic in a retail store. It structurally breaks the business model.
Okay, break that down for me. Why is a snowstorm such a uniquely catastrophic event for their margins?
Well, Jim Fish specifically pointed to the East Coast winter weather, heavily citing the Boston area. They had 3 feet of snow, which he noted was something they hadn't dealt with in that region in 15 years.
That's a lot of snow.
Right. And you have to consider the physical reality of a garbage truck. These are 40-ton vehicles operating on residential streets. If a municipality doesn't plow a neighborhood, a garbage truck simply cannot enter it.
Oh, they just get stuck.
Exactly. Jim Fish noted they had massive facilities completely shut down for up to 10 days.
10 days of zero collection. Okay, I can see how that destroys the quarterly math. You still have to pay the fixed costs of the facility and the baseline wages of the employees, but you are generating zero revenue from those routes.
Exactly. And it gets worse. When the snow finally clears, you have to pay overtime to your drivers to go back and pick up 2 weeks worth of accumulated trash.
Oh man, so double the labor cost for the same revenue?
Right, so your revenue's delayed, but your labor costs spike exponentially. Management attributed roughly half of their 1.5% volume miss directly to these weather anomalies.
Okay, fine, I'll give them the snow. But what about the other half? Because weather only covers about 0.7% of the drop.
The other half is what analysts call a tough comp, or a difficult comparison.
Okay.
In Q1 and Q2 of last year, Waste Management saw a massive one-time surge in revenue, about $85 million, due to cleanup efforts from severe wildfires in Southern California.
Oh, right. So they were hauling massive amounts of burned debris, contaminated soil, and destroyed infrastructure.
Yeah.
That drove up their volumes artificially last year.
Yes, it was an $85 million anomaly. So when you compare this year's normalized first quarter to last year's disaster-inflated first quarter, the math makes it look like the business is shrinking.
That makes sense from an accounting perspective, but it still requires us to take management's word that the core business is healthy. I mean, is there any actual counter data to prove that this volume dip is just weather and a statistical ghost, rather than a symptom of a broader macroeconomic slowdown?
There is, and it's buried in the submetrics. Look at their industrial roll-off volumes.
Okay, and for the listener, industrial roll-offs are those massive rectangular metal dumpsters you see sitting outside of large construction sites or manufacturing plants or major commercial renovations.
Right, and those roll-off volumes are highly sensitive to macroeconomic activity. If builders stop building or factories slow down production, roll-off volumes plummet immediately.
They're a leading indicator.
Exactly, and for the last 6 or 7 consecutive quarters, Waste Management's roll-off volumes were negative.
Ouch.
But in this quarter, they finally turned positive. They were up 0.2%.
So industrial activity, at least from their vantage point, is bottoming out and starting to grow again.
Exactly. Furthermore, Jim Fish noted that in the immediate weeks leading up to the earnings call, meaning after the snow melted, their municipal solid waste volume was tracking at positive 4%.
Okay, that's a solid rebound.
Yeah, and their special waste volumes, which includes things like contaminated soil from industrial site cleanups, was up 6.7% when you exclude that wildfire anomaly.
Okay. I will put my skepticism away on the top line. The underlying volume is recovering, but I really want to shift to the bottom line, specifically the cost controls, because this is where the transcript absolutely blew my mind.
Oh, the recycling data.
Yes. The recycling segment data in this quarter makes Almost zero logical sense to me.
You are referring to the commodity pricing crash.
Yes. In Q1, the market price that Waste Management could get for selling single-stream recycling commodities, think baled cardboard, crushed aluminum, raw plastics, that price plummeted by 27% globally.
A massive drop.
Right. And if I am running a business and the price of the only product I sell drops by nearly a third, my profit margin should be absolutely annihilated. I should be losing money.
Mathematically, yes, you should.
Yet, Waste Management reported that their operating EBITDA in the recycling segment actually grew by 18%. How is that physically possible?
It's possible because they have completely overhauled the physical processing of the material. Well, Tara Hemmer, their chief sustainability officer, spent a lot of time detailing their technology-driven war on operating costs. Historically, a recycling plant, or a MRF, a materials recovery facility, was heavily reliant on human labor.
Right. People sorting trash.
Exactly. You had dozens of people standing next to incredibly fast-moving conveyor belts, physically pulling out non-recyclable trash with their hands so that the cardboard and plastic could be baled.
Which means high labor costs, high turnover, and honestly, high safety risks.
Precisely. But Waste Management has been systematically tearing out those old lines and replacing them with robotics and optical sorters.
Explain the mechanics of an optical sorter, because the speed at which these things operate is crucial to understanding the labor savings here.
Oh, it's sci-fi level stuff. An optical sorter uses near-infrared cameras positioned over the conveyor belt. As a chaotic mix of trash and recyclables flies by at high speeds, the camera reads the light spectrum reflecting off each individual item. It can instantly tell the difference between a piece of cardboard, a high-density plastic milk jug, and a non-recyclable plastic bag. In milliseconds, it identifies the exact coordinate of the valuable material on the belt and fires a precise, high-pressure jet of air to shoot that specific piece of plastic off the belt and into a collection bin.
It literally shoots the trash out of midair with wind.
Yes, and it never gets tired, it never takes a break, and it processes material exponentially faster than human hands.
That is wild.
And because of this structural shift to automation, they processed 9% more volume this quarter, but their labor costs plummeted. They basically built a technological moat around their profit margins.
So the market price of cardboard can crash by 27%.
But because the robots have lowered the baseline cost of sorting that cardboard to pennies on the dollar, the overall profit actually grows by 18%.
It is a ruthless optimization of unit economics. But, here's the thing that really caught my attention. The tech edge isn't just happening inside these massive recycling plants, that they are pushing the AI out onto the residential streets.
Oh, the truck cameras.
Yes. John Morris, the COO, talked about the AI-enabled cameras they have installed directly on the garbage trucks.
This is one of the most significant operational shifts in the company's history. They capture over 300 million images a year with these truck cameras.
And we aren't talking about backup cameras for the driver's safety here. When the mechanical arm of the truck lifts your personal recycling bin from your driveway and dumps it into the hopper, there is a camera looking straight down into the trash as it falls.
And they are using artificial intelligence to process 95% of those 300 million images without a human ever looking at them.
Because they are hunting for contamination. And for you listening, contamination is the absolute bane of the recycling industry. If you throw a greasy pizza box, a tangled garden hose, or a plastic bag full of yard clippings into your recycling bin, you have contaminated the stream.
Which is a huge problem.
In the past, that garden hose would get wrapped around the gears of the recycling plant and shut down the whole facility for hours. Or the greasy pizza box would ruin an entire bale of clean cardboard, making it worthless. And Waste Management had no way of knowing whose house the pizza box came from.
Right. It was an untraceable cost that the company just had to eat. But the AI cameras changed the entire dynamic.
Yeah, we say.
The AI analyzes the image of the trash falling out of your specific bin. It instantly identifies the non-recyclable material.
Yeah.
And because the truck's GPS knows exactly which house it is parked in front of, the AI links that image of the greasy pizza box directly to your customer account.
And then what happens? Do they send you like an automated email to educate you?
Initially, yes. They send a notice to clean up your recycle stream. But if you do it again, they automatically attach a financial penalty to your next invoice. They fine you for contamination.
See, I have to push back on the business viability of this.
Really? Why?
I understand why it's brilliant for unit economics. It cleans up the raw material coming into their plants, which makes the end product more valuable. And it creates a brand new revenue stream out of thin air through enforcement fees. But what about customer churn? I mean, if a local family gets a $20 penalty on their trash bill because they threw a yogurt container in the wrong bin, they are going to be furious. Isn't this an absolute public relations nightmare waiting to happen? You are essentially deploying robotic hall monitors to find your own customers.
I mean, if they were operating in a highly competitive market with 5 different trash haulers fighting for every house, yes, it would be a massive risk. Customers would churn instantly.
Right.
But this loops right back to the airspace preservation monopoly we discussed earlier.
Yeah.
In most municipalities, waste management holds the exclusive municipal contract. The local family literally can't switch providers because there is no other provider permitted to pick up trash on their street.
So they have a captive audience.
Exactly. And from a municipal contract perspective, cities actually want waste management to enforce this.
Wait, really? The cities want their residents fined?
Well, cities have strict environmental diversion goals they are legally required to hit. If the recycling stream is heavily contaminated, the city fails its environmental mandates. So the AI enforcement aligns perfectly with the municipality's goals, and waste management gets to monetize the behavioral correction of the end consumer.
Wow. It is automated physical world enforcement at an unbelievable scale. It's fascinating, and we will definitely return to the philosophical implications of this in our outro because it really reframes how we think about AI.
Definitely.
But before we look to the future, I want to look at one more historical cleanup they're executing right now. We have to talk about their healthcare solutions segment, which is primarily driven by the Stericycle acquisition they made a while back.
Right, Stericycle.
Integrating a massive acquisition is usually where companies stumble and burn cash.
Integrations are notoriously difficult, yeah. Especially in a highly regulated field like medical waste, which involves handling biohazards, used syringes, and pharmaceutical disposal for hospitals and clinics.
But the numbers they reported here are staggering. In Q1, the SG&A costs for the healthcare segment decreased by roughly 20%.
That's a massive cut.
It is. And SG&A stands for Selling, General, and Administrative Expenses. For the listener, this isn't the cost of the trucks or the drivers. This is the corporate overhead. It's the back office staff, the HR departments, the IT systems, the middle management.
The bloated middle.
Exactly. To cut SG&A by 20% in less than a year is severe aggressive cost cutting. It drove a 200 basis point improvement in their margins for that specific segment. But my immediate concern is service degradation.
Of course.
I mean, if you fire 20% of the customer service reps and consolidate the dispatchers, usually the service goes into the toilet and hospitals start canceling their contracts.
That is the standard risk profile of aggressive synergy targets, for sure. Yeah. But Jim Fish addressed this directly. He noted that during the initial modeling of the acquisition, they projected they might lose 3 massive national hospital contracts due to the friction of integration.
Okay, and what happened?
In reality, they only lost 1. Their retention metrics have held incredibly steady despite the massive cuts to overhead.
How is that possible? How do you gut the back office without the frontline service suffering?
You do it by fixing fundamentally broken IT architecture. A massive indicator of their back office success is a metric Jim Fish highlighted. Their past due receivables have dropped by 2/3 in less than a year.
Past due receivables dropping by 2/3. Let me translate what that actually means on the ground. When Waste Management bought Stericycle, the hospitals weren't paying their bills on time.
Nope.
And they weren't paying because they were trying to be deadbeats. They weren't paying because Stericycle's internal invoicing systems, their enterprise resource planning or ERP software was likely an absolute mess.
A total disaster, yeah.
Invoices were wrong, services weren't tracked properly, and hospital procurement departments just refused to pay until the invoices were accurate.
Exactly. It creates a massive cash flow bottleneck. So Waste Management came in, ripped out the disjointed systems, integrated the hospitals into their own highly optimized centralized billing architecture, and suddenly all these massive healthcare networks are actually paying their bills on time.
It is not sexy. No one writes headlines about ERP integration. It's just basic corporate blocking and tackling. But fixing a broken billing system frees up millions of dollars in trapped cash.
It does. And because of this operational rigor, Jim Fish stated they remain on track to achieve a run rate of $300 million in total synergies by the end of 2027 from this single acquisition. And they might even beat that number, potentially hitting $325 million.
Okay, so we have a very clear picture of the story so far. They successfully navigated the weather anomalies in Boston. They proved the underlying industrial volume is recovering. They're using near-infrared robotics to crush their labor costs and protect their margins against a 27% commodity crash. And they're executing a flawless integration of a messy healthcare acquisition.
It's a very solid scorecard.
That is an incredibly compelling narrative for the quarter. But as retail investors, we don't buy a stock for what they did yesterday. We buy it for what they're going to do tomorrow. We need to look forward at management's guidance.
Well, management was unequivocal on the call. They are firmly reiterating their full-year guidance.
Okay, so no cuts.
No cuts at all. They expect to hit their revenue targets, and more importantly, they expect to maintain their margin targets, which sit right around 31% for the full year.
A 31% EBITDA margin in a business that involves dragging heavy metal dumpsters around is almost software-like profitability.
It's unbelievable.
And they expect to hit this driven by the volume improvements we discussed materializing in the back half of the year. But, to sustain that kind of margin, you need a growth engine. And they spent a massive portion of this call discussing sustainability and renewable natural gas, or RNG.
This is a major strategic pivot for Waste Management, and it is starting to pay off heavily. They have essentially realized that a landfill is not just a final resting place for trash. It is a massive, slow-motion chemical reactor.
A chemical reactor that produces methane.
Precisely. As organic waste like food scraps and yard trimmings decomposes inside the oxygen-deprived environment of a sealed landfill, it naturally emits landfill gas, which is roughly 50% methane.
Right.
Historically, landfill operators would just burn this gas off in a flare to prevent the landfill from exploding. It was literally a waste byproduct.
But over the last few years, Waste Management has been investing hundreds of millions of dollars in capital expenditures to build complex RNG facilities directly on top of their landfills.
Yeah, they install a network of extraction wells deep into the garbage to vacuum out the gas. They run it through an incredibly complex scrubbing facility to strip out the carbon dioxide, the water vapor, and the impurities.
And what's left?
What is left over is pure methane, pipeline quality, renewable natural gas. They then inject that gas directly into the national energy grid and sell it. They are literally turning garbage fumes into sellable energy.
And management confirmed on this call that they are on track for a $240 million to $250 million EBITDA benefit strictly from these sustainability investments this year.
That's pure profit.
Right. Operating EBITDA in the renewable energy segment more than doubled in Q1, driven by 7 brand new RNG facilities that have come online since the first quarter of last year.
It is a phenomenal secondary revenue stream. But it does introduce a new risk vector to their business model.
Because energy markets are notoriously volatile. If the price of natural gas plummets on the global market, that $250 million target could evaporate overnight. So how are they protecting this massive capital investment from the wild swings of the energy sector?
By aggressively locking in their forward pricing. Tar Hammer noted that they have now price locked 80% of their expected RNG volume for 2026.
80%.
Yeah, back in January, they only had 60% locked.
So they went into the financial forward markets and found buyers willing to guarantee a set price for the vast majority of the gas Waste Management will produce over the next year.
Exactly.
If the spot price of natural gas crashes tomorrow, Waste Management doesn't care because 80% of the revenue is already legally contracted at a fixed rate. That is incredibly smart, conservative financial management. It essentially removes the macroeconomic risk from their guidance.
It does. But the energy market dynamics aren't the only tailwind for this RNG strategy. They also received a massive, unexpected gift from the federal government this quarter.
You're talking about the IRS tax windfall. CFO David Reed discussed this at length, and honestly, the sheer scale of the tax break shocked me.
The IRS recently issued clarifications regarding Section 45 production tax credits. These are federal incentives designed to encourage the development of renewable energy sources.
Right.
Because Waste Management has been so aggressive in building out these RNG facilities over the last few years, they are now perfectly positioned to reap a massive retroactive tax benefit.
Let's put hard numbers on this. How big of a benefit is the IRS handing them?
David Reed announced a retroactive benefit of $27 million, strictly for the 2025 tax year. But more importantly, he outlined an ongoing benefit of $30 million to $35 million annually, every single year, all the way through 2029.
Wow. $35 million a year straight to the bottom line just for doing exactly what they were already doing. The government is essentially subsidizing their profit margin.
And because of this influx of tax credits, management officially dropped their expected full-year effective tax rate down to approximately 23%.
Lower taxes mean more free cash flow. And that cash flow loops directly back into their strategy for shareholder value, which is the massive buyback program they announced.
David Reed confirmed they are aggressively targeting $2 billion in share repurchases for the year. And crucially, he noted that 55% to 60% of those buybacks will be weighted in the second half of the year.
So if you are a retail investor looking at the stock right now, you know there is a $1.1 to $1.2 billion wave of guaranteed buying pressure coming directly from the company itself over the next 6 months.
It's a huge catalyst.
Yeah, the company is acting as a massive buyer of last resort in the open market, which puts a significant structural floor under the stock price. It is very hard for a stock to plummet when the company itself is constantly buying millions of shares every week.
Exactly.
But I want to step back and play devil's advocate here. I want to push back on this flawless 31% margin guidance.
Please do.
Yeah.
Where do you see the vulnerability?
We are sitting in a geopolitical environment right now that is highly volatile. Global conflicts are putting immense pressure on shipping lanes, and we have seen significant inflationary spikes in oil and diesel prices recently.
That's true.
Waste Management operates an armada of 19,000 heavy diesel guzzling trucks. They are one of the largest consumers of diesel fuel in the commercial sector. How does a company with that much raw exposure to fuel survive a sustained geopolitical diesel inflation spike? Won't rising fuel costs absolutely crush this 31% margin guidance they just confidently reiterated?
It is a very logical concern. In fact, an institutional analyst named Konar Gupta asked this exact question during the Q&A portion of the call.
Oh, really?
Yeah. But this is where the genius of Waste Management's pricing structure comes into play. They operate on what is known as a fuel surcharge model.
Explain the mechanics of a fuel surcharge for the listener, because it sounds like they just pass the buck.
They absolutely pass the buck, and they do it mathematically. Waste Management's contracts with their municipal and commercial customers include a specific, legally binding clause that automatically adjusts the final invoice based on the current national index price of diesel fuel. David Reed explained the math perfectly on the call. A $1 increase in the price of a gallon of diesel mathematically translates to about $200 million in annualized surcharge revenue that is automatically mechanically billed to their customers.
Wait, so if a conflict overseas causes diesel fuel to spike by $1, Waste Management doesn't eat that cost. They just instantly pass the entire $200 million burden onto the end customer.
Almost instantly. There is a slight lag, maybe a month or a quarter, depending on the specific billing cycle of the contract. But essentially, yes, the increased cost of operating the fleet is passed through dollar for dollar.
So a diesel spike doesn't actually hurt their baseline cash profits at all.
It protects the absolute profit dollars, yes. However, and this is where financial literacy is crucial, it does create a tiny mathematical drag on the profit margin percentage.
Okay, I need to wrestle with the math on that because that sounds like a contradiction. How can it protect the absolute profit dollars, but simultaneously drag down the margin percentage?
Think of margin as a simple fraction. Margin is your profit divided by your revenue. Let's say you have a hypothetical business with $100 in total revenue and $30 in pure profit. Your profit margin is 30%.
Simple enough.
Now, let's say your fuel costs suddenly go up by $10. Because you have an ironclad surcharge contract, you automatically raise your billed revenue by $10 to perfectly cover that new cost.
Okay, right.
So your new total revenue is $110. Your profit remains exactly $30 because the surcharge revenue simply canceled out the fuel expense.
Ah, I see it. The profit dollar stayed exactly the same at $30, but the revenue denominator at the bottom of the fraction got bigger.
Exactly. $30 divided by your new revenue of $110 is 27.2%. Your profit margin percentage mathematically dropped from 30% to 27.2%, even though your actual physical cash profit didn't change by a single cent.
Wow, okay.
David Reed noted that this exact dynamic created a 20 basis point or 0.2% drag on their operating EBITDA margin this quarter.
That is a phenomenal breakdown. So when retail investors are reading financial news and they see a scary headline that says, Waste Management margins pressured by rising fuel costs, They shouldn't panic.
Not at all.
The absolute cash flow they are bringing in to fund the dividend and the buybacks is completely protected. The margin drop is just a mathematical illusion caused by the pass-through revenue inflating the top line.
Precisely. They have successfully, structurally insulated their core earnings from one of the most volatile and dangerous macroeconomic risks out there.
Which is an incredible segue. We have crunched the headline numbers and explored the scale of their cash generation. We've unpacked the story of optical sorters, weather anomalies, and back-office ERP integrations. We've looked at the locked-in RNG guidance and the impenetrable armor of their fuel surcharge model. Now it is time to bring it all together for you, the listener. We need to synthesize all of this data into a definitive, actionable stance.
It is time for the final verdict.
So, based on the deep dive into the Q1 2026 earnings call, what is our stance on waste management? Are we bullish, bearish, or holding?
The verdict here is strongly bullish.
Strongly bullish. Let's lay out the comprehensive why for the listener. Summarize the bull case based on everything we've analyzed.
The ultimate bull case for waste management is rooted in their proven structural ability to decouple their profits from macroeconomic headwinds. Think about the sheer volume of things that went wrong for them this quarter.
It was a lot.
Recycling commodity prices crashed by 27%. Fuel prices experienced inflationary geopolitical spikes. Severe winter storms halted their highest margin residential volumes in the Northeast. And they had to lap an $85 million anomaly from a prior year natural disaster.
It was a perfect storm of operational friction.
Yet, despite all of that, Waste Management grew their operating EBITDA by 6%, expanded their margins by 110 basis points, and generated nearly $1 billion in free cash flow. They achieved this impossible math through an aggressive deployment of physical world technology. They are using near-infrared robotics to lower their cost floor permanently. They are demonstrating strict cost controls, highlighted by an all-time low employee turnover rate of 17.2%.
Which we didn't even fully touch on, but keeping CDL licensed drivers in the seats instead of constantly spending money to recruit and train new ones is a massive hidden cost saving.
Exactly. They achieved their best safety record ever, and they exerted massive, unyielding pricing power through their airspace preservation strategy.
If you want to put your trash in their highly permitted hole in the ground, you are going to pay their premium because there simply isn't another hole in the ground anywhere nearby.
They hold a physical monopoly in many critical markets, and they're optimizing it with cutting-edge efficiency.
So what is the actionable takeaway for the retail investor listening to this right now? How should they view this specific stock in the broader context of their portfolio architecture?
You have to view Waste Management for exactly what it is. It is not a hyper-growth tech flyer. It is not going to double in share price in 3 months based on a viral product launch. It is a premium defensive compounder.
It is a sleep-at-night stock?
Precisely. For a retail investor looking for bedrock stability in a volatile market, this is a masterclass in capital allocation. They possess a nearly 50% free cash flow conversion rate, meaning half of their operating cash flow turns into pure, unrestricted cash.
That's a massive safety net.
And they have an executive management team that is actively, aggressively returning $2 billion of that cash directly to the shareholders via buybacks and dividends.
Yeah.
If you are looking for a foundational portfolio buy, or if you currently hold the stock, this is an incredibly strong hold. They are executing flawlessly on the variables they can control, and they have built contractual moats to mitigate the variables they can't.
Executing on what they can control. I think that is the perfect summary of this entire earnings call. And it brings us to the end of our deep dive. But before we sign off, I want to leave you, the listener, with a provocative thought to ponder. Something that builds on what we've discussed today, but looks a little further down the road at the shifting technological landscape.
The floor is yours.
We constantly hear in the news about artificial intelligence. The narrative is always about AI replacing software engineers or writing screenplays or generating digital art.
Right, generative AI.
The cultural anxiety is all centered around AI in the digital realm, but based on what we just learned from Waste Management's deployment of truck cameras, the most lucrative immediate application of AI right now might literally be in the garbage.
The 300 million images analyzed for contamination.
Yes. Think about the broader implications of this technology. If an AI camera can autonomously monitor the physical quality of your trash as it falls into a hopper, reference that visual data against complex municipal compliance codes in a fraction of a second, identify your exact geolocation, and instantly generate a punitive financial bill to your account for a minor recycling infraction that changes the paradigm of corporate power.
It really does.
The true financial frontier of AI isn't just generating a funny poem or writing an email. It is automated, physical world enforcement.
It's AI moving out of the purely digital realm and acting as a robotic auditor of human behavior in the physical world, driving immediate frictionless revenue for the corporation.
And Waste Management isn't theorizing about this in a Silicon Valley pitch deck. They are already doing it at scale right now in your driveway. It reframes how we should look at AI investments going forward.
It is a fascinating and, frankly, slightly terrifying glimpse into the future of industrial unit economics.
It really is. Thank you for joining us for this Talk Tickers deep dive. We hope we helped you cut through the jargon, understand the underlying mechanics of the business, and find the signal in the noise of this earnings call.
Always the goal.
Remember, don't just read the top-line headlines. Stay data forward, stay opinionated in your own investing, and never be afraid to dig a little deeper into the unglamorous mechanics of how a business actually works.
Because sometimes the clearest and most profitable diagnostic picture comes from looking in the murkiest, least glamorous waters.
Perfectly said. We will see you on the next deep dive.